In our previous lesson, we introduced capital gains tax and explained that personal representatives will be liable to this tax when they sell estate assets to raise funds and make a gain from the sale. Now, in this final lesson on our Wills and Administration of Estates module, let's look at the liability of the beneficiaries to pay capital gains tax. Now, if the personal representatives do not need to sell estate assets to pay off liabilities, and instead transfer them to beneficiaries under a will, there is no chargeable gain or allowable loss for the purposes of capital gains tax. The beneficiary is deemed to have acquired the asset transferred at its probate value. So if he disposes of the asset in the future, the probate value will be taken as the acquisition price for the purposes of the capital gains tax calculation. So let's look at this by way of an example. You may remember that Greg Smith left his wife's jewellery to his daughter Sophie, and that was left in his will. At the time of his death in May 2022, this jewellery was worth £20,000. The jewellery was transferred to Sophie in April 2023, at which point the jewellery was valued at £25,000. In July 2023, Sophie sold the jewellery for £30,000. So in this scenario, the price at which Sophie is deemed to have acquired the jewellery is the probate value of £20,000, not the value of the assets at the point that they were transferred to her. She is therefore made a chargeable gain of £10,000 and will have to pay capital gains tax on that sum. So to summarise this final section, there are three taxes which personal representatives may be liable to pay. These are inheritance tax, income tax, and capital gains tax. Personal representatives must pay income tax on any income generated by estate assets during the administration of the estate. And this is charged at 7.5% for any dividend income on shares and 20% for all other income. Personal representatives must pay capital gains tax where they sell any estate assets to raise funds and receive a higher price for them than their probate value. In other words, their value at the time of the deceased's death. They must pay capital gains tax at a rate of 28% for any gains made on residential property and at 20% for gains made on any other property. Where the assets are transferred to beneficiaries, the beneficiaries are deemed to have acquired these assets at their probate value, not at their value at the time of transfer. Now that we've studied the liability of personal representatives and beneficiaries to pay capital gains tax, so let's consider a question of the kind that you could get in the SQE exam. A testator died, leaving a will by which all of his estate passed to his two adult children in equal shares. The estate assets included shares in a company quoted on the stock exchange with a probate value of £100,000. Half of the shares were transferred to the son, and the other half were transferred to the daughter. At the date of transfer, the total value of the shares was £150,000. A month later, the son sold all his shares and the net sale proceeds were £85,000. 2 months later, the daughter sold all of her shares and the net sale proceeds were £45,000. The executor has not yet completed the administration of the estate. Which of the following statements best describes the capital gains tax position on the shares sold during the administration period? A. The son will make a gain, the daughter will make a loss, and the executor will make neither a loss nor a gain. B. The son will make a gain, the executor and the daughter will make neither a loss nor a gain. C. The executor and the son will make a gain, the daughter will make a loss. D. The executor will make a gain, the son and daughter will make neither a gain nor a loss. E. The executor and the son will make a gain, the daughter will make neither a loss nor a gain. The correct answer is A. The son will make a gain, the daughter will make a loss, and the executor will make neither a loss nor a gain. So answer A is correct. By way of explanation, at the date of the transfer, each sibling receives a shareholding valued at £75,000. However, they are deemed to have received these assets at their probate value, in other words, £50,000 each. If the son's net sale proceeds total £85,000, this would mean that his gain would be the value of £85,000 minus £50,000, which equals £35,000. The daughter's net sale proceeds total £45,000, so she has suffered a loss of £50,000 minus £45,000, in other words, £5,000. The executor has incurred neither a loss nor a gain because the transfer of the assets to beneficiaries is not considered to be a disposal for the purposes of capital gains tax.